Assalamu alaikum students and good morning. This is today inshallah we will discuss chapter 12 which is about intangible assets. So in this chapter we'll discuss the meaning of intangible assets. We'll talk about the different types of intangibles. We'll look into the accounting treatment of intangibles and the way in which we are going to expend it during its life. We'll talk about impairment and reversal of impairment of different types of intangible assets. We'll also talk about a special topic for research and development cost and how to treat it in accounting. And so let's start with the discussion of what is intangible asset. So we know what is an asset. Asset are those items in your business which you have spent amount for and you're going to use it in your business, isn't it? So there are two types of asset as we saw in accounting. One is current and another one is non-current. So non-current assets, one part of it we have already discussed in the previous chapter. We talked about non-current assets like property, plant, and equipment. In this chapter, we'll talk about another non-current asset, which is intangible asset. So, what are intangible assets? So, basically, intangible assets are those which do not have a physical existence, but still it is an asset which we use maybe for a long period of time in our operations to gain some profits. So, the characteristics of intangible assets are first one, it is identifiable. It's not something which you are not aware of. Basically, it is an item which you know exactly what it is. For example, let's say license. Maybe you have taken a license from the government to run the business. So you know it is something for which you have paid some money and you have paid it for a specific reason to run your business with permission from the government, right? So it is identifiable. You have paid a specific amount of money for a specific thing, that is the license for a specific duration. Maybe you got a license for 10 years. So yes, it is identifiable. However, it does not have any physical existence. That means if I say license, basically in the business I would say yes, I do have a license, but if somebody tells me I want to touch the license, no, you cannot, because it does not have any physical existence. So physically it may not exist. It may be there only as a contract, or it may be there only as some rights to run the business or something like that. Okay. And it is not a it's not monetary asset. I mean, we are not considering it as a monetary asset in the sense that you it's not have it is maybe you cannot simply sell it and make money, or maybe it is not in the form of cash, right? So we could move ahead and talk about the classification of intangible assets. So intangible assets normally are classified as marketing related, if it is got to do something with marketing your products. Customer related, if it is something to identify yourself with the customer. Or artistic related, maybe some value that you receive from the artistic creation that is done by the company. Contract related, where you are undergoing some contract and because of that contract you are gaining some value. Technology related, anything to do with the technology. And finally, goodwill. Maybe you have already defined goodwill in accounting one. You know what it is. It is actually the value of the company, as it would add value to your earning capacity uh, in your business, right? So basically, we also need to understand that goodwill is something that you gain only when you're buying certain assets, right? So let's go ahead with how would you value intangible asset. So like any non-current asset, we need to understand that whatever you're paying to buy that asset, you need to capitalize it. So fine, so you will be taking the cost of purchasing of intangible asset. So you have to record the value that you paid at cost. It will include all the acquisition costs plus any expenditure that you have spent to make your intangible asset ready for its intended use. For example, maybe if we are talking about patent is an intangible asset. It is the right that you get to produce a particular item, right? So what are the various expenses that you spent in order to make the patent yours? So all those items are allowed to be added to the cost of purchase. For example, it could be the purchase price, it could be the legal fees, or any other incidental expenses that you spent in order to acquire the intangible asset, right? So let's also talk about two variations of intangible assets. For example, let's say you have a patent. A patent could be something that you have purchased from another party, so it could be externally purchased, or sometimes maybe you have created it yourself, so you may talk about it in that way. Internally created intangible, so in that case it could be patent, or maybe some computer software that you have created, maybe the copyrights for some maybe printed or acquired items, or it could even be the trademark of the company. So there are two ways of getting this. One is you may buy it from outside, or maybe you have internally created it. So if you have internally created it, then you would expend all your expenses during the research phase, and maybe some expenses during the development phase. Inshallah, we'll define research and development in the upcoming slide. However, we need to understand that um, if you have created your intangible asset internally, then you may have spent some money to create it, maybe doing research, or maybe conceptualizing it and even putting it into practice in the developmental phase. So what you need to do is consider both of these expenses. In the research phase, you have to expend it, that means you have to put it in the income statement. And in the developmental phase, maybe some part of the developmental phase, once you have decided that yes, now I can take benefit out of it, then only you can capitalize it, otherwise you need to expend it. Okay, so a certain developmental cost can be expended once the economic viability criteria are met. Okay, so let me underline that economic viability criteria. Now, what does that mean? It means that once you realize the value, and you're sure that now you can make benefit out of the created intangible asset, then only you can capitalize it. Until that, you cannot consider it as a asset. You have to treat it as an expense. Right? That's the idea. So IFRS says several specific, you have to use specific criteria before you can decide that your developmental cost can be capitalized. So again, as a company, you need to prove that the expenses that you have spent on creating some intangible asset is actually achieved before you can treat it as an asset. Otherwise, you need to consider it as an expense, right? So here is a diagram which actually explains that. Let's imagine that maybe you have started you've started a project, and in the initial stages of the project, it is maybe you do a lot of research, you put things into put things into practice, and you spend a lot of money, maybe till a particular point in time, from the time you begin your project till the time your maybe intangible asset is ready for use, or maybe to selling it to another party. Maybe there is a point you reach where you think that yes, now the project is ready to be sold, or now the project is ready to be used. Until that time, if you spent anything, then you call it as a research phase. In your research phase, you can only expend it, that means you can not treat it as an asset. You have to consider it as an expense and put all the expense in your income statement. But at the point where you decide that okay, now it is ready for sale or use, then you say that you have achieved the economic viability for that asset, and then you can consider it as an asset and capitalize it, that is, you can treat it as an asset, as an intangible asset. So maybe from the research phase to the development phase, it's possible that all of your research phase and some part of your development phase can be treated as an expense, and only at a particular point in time, when you identify the economic viability, you can treat it as an asset. Okay, so with that, let's go on. So let's say you have decided that you have an intangible asset, and you have put capitalized it, that is, you have treated it in your balance sheet. Now comes the time to amortize it. If you remember from your accounting 2 classes, amortization, this is the word which is similar to depreciation for plant assets. Here it means that over the useful life of the asset, you are now expending the value of your asset, right? So there are some conditions for intangible assets. You can amortize only those assets for which you know the life. So if you have a limited life intangible, then you will amortize it by systematically charging the value of the asset over its useful life. You use a straight line method to amortize the value of your asset. Amortization expense must reflect the pattern in which the company consumes or uses of the asset. So, for example, let's say you have a patent for 10 years, then you need to use a straight line method. You take the cost of the asset and divide it by the useful life, and every year it uses up maybe 10% of the value of the asset. So, you're going to amortize 10% of the value. Okay, so you will credit the asset and you are going to debit the accumulated amortization. This is your journal entry. Debit accumulated amortization and credit that asset itself. So if it was a patent, you're going to credit the patent. And amortization should be cost less the residual value. So of course, like in a plant asset, you have to calculate the depreciable value. Similarly, in the amortization, you will calculate the amortization only after calculating the amortizable value. So companies must evaluate the limited life intangible annually for impairment. Again, just like plant asset, every year, at least once in a year, the company has to find out if there was any impairment for the asset. Fine. So if it was an indefinite life intangible, then if you do not know how many years you're going to use a particular asset, or even maybe you do not have any foreseeable limit on the time that the asset is going to give you the cash flow. If you think that this particular asset is going to give you a cash flow forever, in that case you will not do any amortization. You keep the asset in your balance sheet, and of course you're going to evaluate for impairment at least once in a year. And if you think that the asset has impaired, then only you're going to expend the loss for impairment. Okay, so we'll talk about this in the upcoming slide, but right now let's talk about amortization. In this table we are summarizing the various treatment for intangibles. So if the intangible has a limited life, in that case the purchase price, uh, I'm sorry, here let's look at this one. Here I would say that if you have purchased it, or if you have internally created it. Okay, so in this case, suppose your intangible has a limited life and you have purchased it, the whole of the purchase value will be capitalized. While if it was internally acquired and it was a limited life asset, in that case, yes, you will be treating it as an expense for the research part of it, and of course certain part, if it is meeting the economic viability criteria, then you're going to treat it as a asset and capitalize it. So in that case, purchased intangible asset will be amortized over the useful life, and every year you're going to check for the impairment, and you need to compare, I mean, to test for impairment. It is similar to the plant asset. You compare the recoverable amount to the carrying value. If the recoverable amount is less than the carrying value, then you find it to be having impairment loss and you will treat it accordingly. Okay, so that is if your asset has an intangible life, limited life. If your intangible asset has an indefinite life, that is, if you think that you're going to get the benefit from this asset forever, the same thing, if it was purchased, you will capitalize the whole value of it. If it was internally created, then follow the rule that I discussed in the previous slide, that is, up to a certain extent it will be expensed, and only once you decide that the asset can be has an economic viability, at that point you can capitalize it, and there is no need to amortize. Only thing you need to do is compare the recoverable value to the carrying value, and then decide if there is an impairment loss, and if you find that there is an impairment loss, then expend it. Fine. So let's go on to talking about the different types of intangible. I'll discuss this in a little bit of detail, and maybe we can also consider this for theory questions and the exam. Okay, so here we'll talk about different categories. As discussed earlier, you have 6 categories: market related, customer related, artistic related, contract related, technology related, and goodwill. So let's start with the first one, marketing related. So if you have acquired an intangible asset specifically to make a gain in the marketing aspect, then you call those assets as marketing related. So for example, it could be trademark, trade name, and so on. So maybe you may have a newspaper masthead, internet domain name, or maybe non-competition agreement. So any agreement which gives you a marketing advantage such that you can use a particular trademark but no one else can use it. So you may register your trademark or trade name. In that case, it is something that is going to give you a marketing benefit. So you call it as a marketing related intangible. So under the common law, that is internationally, it is possible that if you have acquired a trademark, then you get a right to use this trademark exclusively. And maybe if you have purchased the trademark, then you can use it with the original user as long as the original user continues to use it. So that's why we say that it is giving you a marketing benefit, and whenever you purchase such a trademark or trade names, you can capitalize the purchase value. That means it becomes a intangible asset in the balance sheet. And since we do not know how long we are going to use the trademark, there is no need to amortize it. Okay, so I'll just keep off this example. You can check it out in the textbook. I'll go to the second type of intangible asset, that is customer related. Here you would be having an example. For example, maybe you have a list of customer, maybe you have some order from the customer already in your name. Maybe you have some contracts with the non-contractual customer relationship. In this case, it could be maybe sometimes between companies you may buy or sell these type of assets, and in that case you can capitalize it as you have an advantage over your customer for a particular order, or maybe for a list of order over a period of time. In this case, yes, you may know exactly how many for how many periods or how many years you will be using this list of customer or the order backlogs. In that case, yes, you can amortize it for the useful life. Here, let's look at an illustration. Let's say a particular company, Green Market, acquires the customer list of a large newspaper for 6 million euros on January 1, 2019, and they think that they're going to get benefit from this information over the next 3-year period. So in this case, what you would do is, if you have acquired it, you have purchased this as an intangible asset, and you know that you're going to use it for 3 years period. So you need to first maybe record the purchase of the customer list, and secondly amortize this asset over the next 3 years. Of course, most of the intangible assets we use straight line method, right? So first, journal entry for acquisition of intangible assets. So you will take customer list, that is the name of your asset, debit it with 6 million euro, and cash for the cash that you have paid for acquiring this asset, 6 million euro. And at the end of the year, you need to amortize it by taking the straight line method. So here it is said that the useful life is 3 years. So yes, you can divide the cost of the asset by 3 years. So amortization expenses, 6 million divided by 3 is 2 million, and customer list, that is the name of the asset, you need to directly deduct the directly credit the name of the asset itself. Okay, now here if you can see here in the bottom they've given you a star, and they're saying you that you could also credit an account called as accumulated amortization. This is for those companies which would like to use the accumulated amortization, like it is just like your accumulated depreciation. You can also treat it in that way depending on the method of amortization that you will use. Okay, we come to the third type of intangible asset, artistic related intangible asset. Now sometimes maybe you have certain design, or maybe you have let's say maybe can I call it as a um, blueprint or things like that, which has some artistic value, maybe some plays, literary work, or maybe a copyright to a particular picture, photograph, video, and so on. In those cases, if you acquire this for their artistic value, you may call it as artistic related intangible asset. Maybe copyright, for example, for a particular asset for a particular number of years. Okay, so in that case, yes, you can capitalize the cost of acquiring and defending that right. And then since you know the number of years that you're going to use it, then yes, you can also amortize it over its useful life. Now here there are two things. One is a legal life, and then there is a useful life. You need to understand legal life is the number of years that you are legally entitled to use the asset. However, legal life can sometimes be longer than the useful life. In that case, we don't use the legal life, we use the useful life. Okay. Next we talk about contract related asset. In this case, if you have an asset as a result of some contract that you have created, for example, maybe you have a franchising contract, or maybe you have a licensing agreement, or maybe some construction permits, maybe some broadcast right, service and supply contracts. In this case, we would say that these rights you have acquired because of some agreement with the person already holding such an asset. It's possible that you may have these rights according to which you will be actually using a particular trademark, or maybe you will be using a brand name as a result of some agreement. Okay, so in that case, we say we would be calling them as contract related intangible asset. For example, franchise or license with a limited life, you need to amortize it as an operating expenses over the useful life. And of course, the cost of acquisition can be capitalized. Okay, so but if you have a franchise with indefinite life, then you need to take it at cost, you cannot amortize it. However, every year you're going to check for impairment. Okay, fine. I'll go to the next item, that is technology related intangible asset. Sometimes you may have purchased some patent or maybe some trade secret by a government or things like that, which is related to technology. In that case, we say that this is a technology related item, maybe a patented technology and so on. So usually it can give a patent holder a right to use that technology maybe for some year. Usually internationally it is a period of 20 years. Of course, you need to capitalize the purchase price of this asset. Okay, and if you have spent something on R&D, then you follow the same rules which I discussed before. That is, if there was an R&D cost or any then you could expend them all, and if there was a development cost and you can prove the economic viability, then you can treat it as an asset, and of course amortize it over the legal life or the useful life, whichever is shorter. So just like the previous example. Okay, let's look at it. Look at an illustration here. Let's say haircut company, it incurs $180,000 on the legal cost on January 1 for defending a patent. The patent's useful life is 10 years and you can amortize it on a straight line basis. So again, like in my previous example, here also you will do the same thing. First is you're going to record the cost of the patent, and then secondly you're going to amortize it over its useful life for the next 10 years. Okay, so the entry would be patent is debited for acquiring and cash is paid, so cash is credited. And at the end of the year, you need to calculate the value of your patent. 180,000 divided by 10, so you will be saying 18,000 is the amortization expenses, and the entry would be patent amortization expenses debited, and the patent or accumulated amortization, whichever the company is using, would be credited. Right, and then we come to this last item, that is goodwill. Goodwill is a special type of intangible asset. It does not happen in the regular operation of the business. It can only be shown in your balance sheet when you are actually buying a company with its goodwill. Okay, so what is goodwill conceptually? It says the future economic benefit that you may get from the use of the assets that you have acquired from another business, which you cannot individually identify, or you cannot separate it into different forms. Okay, so you can only record it when you are buying an entire business. Okay, so and you can measure it as an excess of the cost over the fair value of the identifiable assets that you have acquired. So let me explain that with an example in the next slide. So normally, if you have acquired goodwill internally, that is, maybe if you're taking over your own subsidiary, or maybe if you find that the fair value of your asset is more than the value on the balance sheet, in that case it is called as internally created goodwill. Then you cannot capitalize it, you have to consider it as a gain and simply put it in the income statement as a revenue. Okay, so anyways, let's look at an illustration here. Let's say Feng Incorporation, it has decided that it needs a parts division to supplement its existing tractor distributorship. So what the company does is it is interested in buying a tractor link company. It's the name of the company. So let's look at the illustration here. Here is the financial position of Tractor Link company, the company which Feng is interested to buy. Okay, so if you can see, the assets are totally valued at 255,000, and also there is a current liability of 55,000 for this particular asset. Okay, so with this, let's go ahead. Suppose the Fang is investigating and trying to find out what is the fair value of these assets for the company. So here is a list of the fair value. So suppose the company finds that these are the fair values of all the assets in the balance sheet, and also it has a liability. So here is a minus item. So on the whole, when they take assets minus liability, suppose the purchasing company finds that the fair value of the asset is 350. So I'll just go back to the previous slide. You could see the actual value, or we can say the balance sheet value of the company was 255 minus this 55,000, which is the current liability. So in that case, you could see that the fair value is 350,000. Even then, the company has agreed to buy out this asset for 400,000. So now, what is the goodwill, if any? So as you could see, definitely the fair value is higher than the book value of the asset. However, we don't need to consider the book value, because when you buy a new company, you need to consider the fair value at which you're buying. Still, you could see that the fair value is 350, but the company will pay 400,000 to buy the asset. So can you clearly see that yes, there is a goodwill. The fair value is less than the price that you paid for the asset. So the difference between the fair value and the price is the goodwill. The price you're paying is higher than the fair value. So there is a goodwill, right? So in that case, the company will be assigning these values to its assets. So it will put all the value according to the fair value, as you can see here, even for the liability. And then it would say the fair value of all the identifiable asset is 350, and the purchase price is 400,000. So that means the difference between that, the higher value that the company is paying, the extra money that the company pays, 50,000, is for the goodwill. So in such a situation, when the company is actually buying out another company and then it pays a value which is more than the fair value of the company, then you say there is a creation of goodwill. Okay, so yes, in that situation, the company has to record the transaction in this way. It has to debit all the asset that is acquired. So at the fair value, so it has acquired plant, property and equipment, it has acquired patent, it has acquired inventory, it has acquired receivable, cash and goodwill, as you calculated in the previous slide. It has also acquired liability, so you credit the liability and you credit cash for the amount that you actually paid for the company that you have purchased. Fine, so yes, you will pass this entry and of course record it accordingly in the balance sheet. Fine, so now we'll talk about goodwill. What about goodwill? Are you going to write off the goodwill? Now, if you have a goodwill, normally we consider goodwill to have an indefinite life. And remember from our discussion before, any intangible asset which has an indefinite life will not be amortized. So by default, goodwill is considered to have an indefinite life. So we do not amortize goodwill. But at the end of the year, you need to always test if there was an impairment of a goodwill. If there was an impairment, then yes, you need to adjust for the loss on impairment, if any. Right? Now let's talk about bargain purchases. Now suppose you find, okay, let's take the previous example. We found that the fair value was 350,000 and the company paid 400,000. That means you have actually purchased the asset with the goodwill. But what if things were opposite? Let's say you found the fair value was 350, but you paid less than that. What if you paid 300? In that case, we understood that we have gained by the purchase of this particular company, and you treat it as a gain and record it accordingly in the income statement. Fine. So let's go to the next topic, impairment of intangible asset. I hope you will remember the discussion of impairment from the previous chapter. However, let us discuss that again. Okay, so what is impairment? Now, sometimes when you have already produced the value of your asset, whether it is intangible or property, plant, and equipment that we discussed in the previous chapter, we need to note that sometimes the book value of the asset, that is the carrying value, could be higher than the actual recoverable value or the value in use of the asset that we are actually using. In that case, it's essential that the company needs to check for this particular impairment every year, at least once in a year, and make the adjustment in the income statement for impairment loss, if any. Right? So an intangible assets can be impaired when the company is not able to recover the assets carrying amount either by using it or selling it. So if you will notice, the definition for impairment is the same whether it is a PPE, that is plant, property and equipment, or it is an intangible asset. So you should follow a specific procedure to identify if there is an impairment and then adjust it accordingly. So first thing is whether the intangible asset is of limited life or if it is of indefinite life, right? So here we'll look at this one. The rules that apply for impairment of property, plant and equipment also apply for the limited life intangible asset. So if the intangible asset is of limited life, then the treatment is similar to PPE. So first thing is, first identify if there is an impairment loss. How do we do that? If you remember from the previous slide, we need to compare two things. That is the carrying amount and a recoverable amount. By recoverable amount, what we mean is the amount higher of the fair value of the cost minus the cost to sell or the value in use. If you're using the asset, you calculate the value in use. That is what would be the value of using this asset for the remaining life of the asset. And fair value minus the cost to sell is if you're planning to sell off that asset, what value do you think you're going to realize from the sale. So compare these two numbers and the higher of the two will be considered as the recoverable amount. Now you compare the carrying amount to the recoverable amount. If the carrying amount is higher than the recoverable amount, then we say we have an impairment loss. Okay, so here you could see that the fair value less cost to sell means the value the asset could be sold after deducting the cost of disposal, and value in use means the value of the cash flows, the expected future cash flows considered at the present value as on the date of valuation. Okay, so as on today, I would say that. Right, so let's take an example here. Let's say Lurch SE has a patent on how to extract oil from shale rock with a carrying value of 5 million euros at the end of 2018. However, because of several recent non-shale oil discoveries adversely affected the demand for the shale oil technology, indicating that the patent is impaired. Okay, so Lurch determines that the recoverable amount of the patent based on the value in use because there is no active market for the patent. Lurch estimates that the value in use is €2 million based on the discounted expected net cash future cash flows at the market rate of interest. Okay. So with that, let's now calculate the impairment loss. So what we need to do is we need to take the carrying amount which is given in the previous slide and compare it with the recoverable value, right? So in this case, we found that 5 million euro is the carrying value and the value in use is 2 million. So we don't know what is the fair value. So we'll take the 2 million and compare it with the carrying value. So clearly you can see that the carrying value is higher than the recoverable amount. So yes, we have an impairment loss of 3 million euros. So we pass an entry for that. What's the entry? Loss on impairment 3 million and directly credit the patent, that is 3 million. Okay, so what if later you found that there actually is a value, recoverable value has increased in that case? So let's look at that. We call it as reversal of impairment loss. Again, we are talking about limited life intangibles. So let's say during the duration of its timeline, we found that a particular intangible asset after its impairment is found to have a value above it. Okay, so let's look at that. So if the carrying value of the patent after impairment is 2 million, okay, now, so let's say the company wants to amortize it for the 5 years. So we would say each year they want to amortize 400,000 euros. That is 2 million divided by 5 over the remaining 5 years. So let's first calculate the carrying amount for each of the remaining 5 years. Fine. So in the first year, 2019, 400,000 will be the amortization expense. So the carrying amount is 2 million minus 400,000, that is 101,600,000. In the second year, another 400,000 will be expended as amortization. So in 2020, so here you will have 1,200,000. How did you get that? That is 2 million minus 800,000. So similarly, in the next year, with amortization, so you get a carrying value of 800,000. That will be 2 million minus 120,000. And again in the fourth year you will have an amortization of 400,000. So at the end of the 4 year, the carrying value will be 400,000. That would be 1 million minus 1,600,000. And in the last year, when you charge the last amortization figure, the carrying value would be 0. Okay, so imagine now we are talking about reversal of impairment loss. Let's say in 2020, that is after the amortization in the second year, based on the improving conditions in the market for shale oil technology, let's say the company remeasures the recoverable amount of the patent and they found that the recoverable amount is 1,750,000. Now in this case, Lurch finds that the recoverable amount is more than the carrying value. So I'm just going back to my previous slide. So what was the carrying value in 2020? Okay, so you could see that at the end of 2019, the carrying value is 1,600,000, because now they're talking about early 2020. That means in the beginning of 2020, we can consider that as the carrying value. So the carrying value is 1,600,000, while the recoverable value is 1,750,000. So we now find out the difference between the two. So we say that the value of patent has actually increased by 150,000. In other words, the loss that we have deducted as loss on impairment can now be brought back. So we will debit patent for 150,000 and we will credit recovery of impairment loss for 150,000. So this is how we reverse the impairment loss if in the future we found that the patent has gained its recoverable value. Okay, now we'll go to the second type of impairment, intangible assets, which has indefinite life. For example, asset which we do not know how many years you're going to use it. Okay, now this one we have to takes other asset, not the goodwill, because for goodwill the treatment we have already seen, right? So let's talk about this. So should be tested for impairment at least once in a year. Every intangible asset which has an indefinite life, though we are not amortizing it, remember, for indefinite life you do not amortize it, even then every year you have to check for impairment. So impairment test is same as that for limited life asset, that is you need to compare the recoverable amount with the carrying value, and if the carrying value is more than the recoverable amount, then you say that there is an impairment loss. Okay, so this is what I meant. Okay, so now let's look at this with an example. So let's say Aircon Radio purchased a broadcast license for 2 million euros. The license is renewable in 10 years, every 10 years. So Aircon Radio has renewed the license with the GCC twice at a minimal cost, but because its expected cost flow is going to last indefinitely, they report it as an indefinite life intangible asset. What? The license. Okay, so the broadcast license is the asset, and they think that it's going to have an intangible indefinite life. So recently, GCC decides to auction these licenses to the highest bidder instead of renewing them. So based on the current auction of similar licenses, Arcon thinks that the estimated fair value of fair value minus the cost to sell, that is the recoverable amount, is 1,500,000. Note that the value for purchase is 2 million while the cost identified is 1,500,000, right? So here when we compare the carrying value with the with the recoverable value, we found that there is a loss on impairment of 500,000 euros. So this, of course, we pass the same entry like we saw before, and of course treat it accordingly. If there was a reversal, yes, you do the reversal of impairment losses. Now we'll look at impairment of goodwill. Normally, you have to evaluate for impairment at least once in a year. If you have a goodwill in your balance sheet, you need to test for impairment at least once in a year. And I mean, the conductant. How do you do the impairment test? So basically, you need to check out the cash generating unit uh, of the for which the goodwill has been assigned. So you remember, goodwill is coming out of a particular business, isn't it? So because you purchased a particular business and you paid a higher value for that business than the fair value of its asset, that's where you had the goodwill, right? So you need to evaluate the cash generating capacity of that business every year and decide whether the goodwill that you have put is still valid or not. So what does that mean? Cash generating unit is the smallest identifiable group of asset that generate the cash flow in that particular business. So you need to estimate the recoverable value of the recoverable amount of the goodwill impairment, and you will take it under the method value in use. That is, if I use this asset for whatever number of years, how much benefit will I get? Okay, so normally once you have assigned an impairment loss on the goodwill, for example, let's say you found that the value generating capacity of that asset has decreased less than the uh, calculated value of goodwill on your balance sheet, and you have, let's say, treated impairment loss, then in no condition you are allowed to reverse the impairment loss. Okay, so this is something, a special treatment for goodwill as compared to other intangible assets. So let's explain that with an example. Let's say this company Kohlbai has three divisions. It purchased one division PIT product 4 years ago for 2 million euros. Unfortunately, PIT experienced operating losses over the last 3 quarters, and now the management is reviewing the division. That is, they're trying to calculate the cash generating unit for the purpose of its annual impairment testing. So let's look at this illustration. So let's list of PIT's division net asset, including the associated goodwill of 900,000 euros from the purchase. Okay, so this is the value of their assets for the time duration, and there is a liability also. So the net asset is 2,400,000 euros. Now company is trying to find out the value in use, and say it has estimated that 2,800,000 is the value in use. So they calculate the impairment in this way. The carrying amount from the previous slide is 2,400,000 and the value in use in 2,800,000. Now compare that as a recoverable amount. So what do you think? Is there an impairment loss or no? Carrying amount is less and the recoverable amount is more. So there is no impairment losses. In fact, the recoverable amount is more. Right? Assume, let's continue this. What if the recoverable amount was 1,900,000? So the same thing, take the carrying amount 2,400,000 and the value in use is 1,900,000. In this case, can you see the recoverable amount is less than the carrying amount? So in this case, yes, there is an impairment loss of 500,000 euros. Okay, and the entry for impairment loss is just like any other entry. You will say loss on impairment and goodwill will be credited. Okay, so that would be the different types of intangible assets and the treatment, amortization and impairment losses and reversal of impairment losses. Fine, so we'll go ahead with the presentation of intangible assets on the balance sheet. So now we understood that it is a non-current asset. So you need to report each item separately and separate them all other than the goodwill. So sometimes you can put goodwill as one item and all other intangible assets separately. Reporting is similar to reporting of PPE, so that means you will be showing it in the balance sheet as non-current asset, and and systematically every year you will be creating. Creating an amortization, and you will amortize it as an expense. One thing you need to understand is that normally for intangible asset you don't create a contra account. If you remember, I was discussing this in the previous slide, that whenever there is an amortization expenses, you directly credit the asset itself. You do not credit accumulated amortization, though it is allowed in certain situation. Normally it is not allowed. You do not have accumulated amortization. You directly have amortization expenses and credit the asset itself. So if you are amortizing a patent, you will credit patent. If you are amortizing a goodwill, you will credit goodwill, and so on. Okay, so in the income statement, you will be showing the amortization expenses every year when the amortization takes place, and impairment loss, if any, as we saw before. And if there was a reversal, this one will also be shown in the income statement. For intangible assets other than goodwill, you have to show it separately in the net income, usually in the operating section. So if there was any amortization for any period, there was an impairment loss or reversal, you have to show it also as a notes to the financial statement. You need to talk about what type of asset was amortized and other details about them. Okay, so notes is also required. So this is how the intangible could be shown. Let's say if you're showing the intangible assets, you would be putting it in the income statement. You will be writing amortization expenses. You will also be talking about impairment of goodwill. While in the balance sheet, you will be showing the goodwill with the notes, and also you will show all other intangible assets maybe as a separate header. Fine, we'll come to the last objective of the chapter, that is research and development cost. Research and development, as I hope by now you have understood briefly about it. It is, if you are creating the intangible asset by yourself, you may have spent you may have spent amount of money for doing research and developing the asset by yourself. So most of the time, the best example is for the patent or for the copyrights. So in that case, you may have intangible assets for creating some product, for processes, for ideas, for formula, for composition, for literary work, whatever type of intangible assets you are creating. Okay, so here is just to show you that research and development actually is a huge expense in most of the companies. Here are some examples of companies given, most popular companies. These are the sales figure, and then they say that most of the time these companies spend from maybe something but from 3% to 20% of their sales expenses maybe on research and development. So in that case, you need to understand that companies actually spend huge amount of money on research and development, and sometimes company are concerned that if this amount of money is going as expense, their profit figure would be affected, right? So there comes the discussion of, will the company be allowed to treat research and development as asset? Okay, and the answer is no. Research and development, research especially, cannot be treated as an a asset. They have to be expensed, whatever be the amount, whether it's 20% or more than that. Whatever the company is spending on research cannot be called as an asset. It has to be expensed. But when we talk about development, okay, what's the difference between research and development? Research is what you spend on studying about a particular maybe product or things like that, or maybe anything that you spend on finding out and collecting data, treating the data, analyzing the data, and so on. While development may be something physical, maybe the findings from your research could be converted into maybe a prototype, maybe your design, or maybe things which could become useful for the future. So here, that's why we companies can separate between them. Research, if the expense in question is for research, you cannot treat it as an asset. You have to expend it. Okay, but if it was a development, then you have to first prove that there is a economic viability. Once you prove that there is an economic viability, the part of that expense can be capitalized. Okay, so capitalization will begin when the project has reached far enough in the process such that the company can see that they can get some economic benefit from the R&D project that they have considered. So the technical word for that is economic viability. Okay, so once the company decides that there is an economic viability, they can capitalize it. So how do you identify whether it is a research and a development? So normally research activities could be your original planned investigation, which is undertaken with the prospect of gaining some technical or scientific knowledge and understanding. For example, laboratory research aimed at discovering new knowledge, searching for application, new research finding, maybe development of new softwares and things like that. While when we talk about development, here we talk about applying the findings from the research in order to do something very substantial. Maybe you improve the material, or maybe you create a device, maybe you create a product or a process or a system or a service before you can actually commercialize it, right? So for example, let's say the conceptual formulation of the design, a possible product, or even maybe prototypes, or maybe beta version of your software, pilot plans, and so on. So these could be development, right? Now if I were talking about accounting for R&D, remember that if you're having an R&D material, equipment, facilities, you can have some personnel or human resource expenses, you may have some purchased intangible assets, you may have some contract services, indirect costs, and so on. So here we'll look at this illustration, we'll try to see what is the accounting treatment for this. Please pay attention to this part, because here we are clearly discussing things that can be asked for the exams. Okay, so if look at the type of the expenditure, and we will discuss what treatment for it. So let's look at this one: construction of long range research facility for use in current as well as future projects. Okay, so it is a 3-story 400,000 square feet building. So if you can see, this is something meant for research, but if you can see, there is something concrete which you are using for today and also for tomorrow. In that case, you will capitalize this expense, because it can also be a building, maybe, and you will depreciate whatever used as research and development expenses. Okay, secondly, acquisition of R&D equipment for use on the current projects only. So now here there is a very clear cut definition that you're going to use this only for the current project, and it is meant for the, you have purchased this R&D equipment for this current project. So yes, you cannot treat it as a capital expenditure, you have to treat it as a expense. Okay, expenses, expend it immediately as R&D. Okay, let's say you have acquired a machine for use in the current and the future R&D project. Yes, now you can capitalize it and depreciate it as an R&D expenses. Now, next example, let's say you purchase some materials which you're going to use. Now, this is not any fixed asset, it is some materials which you're using for current and the future projects. In that case, you will treat it as an inventory and allocate it to the R&D project. Inventory can be your current asset, and expend the amount as you are consuming it. Okay, next one is salaries for the research staff. Now, can you see there is no such fixed asset or fixed assets created, so you can simply expend the salaries expenses as R&D. Research cost incurred for the contract with the New Horizon, and you will be sending a bill to this company monthly. Now, what does that mean? You have spent some cost, but then you will collect that back from another company called New Horizon. In that case, it can be a receivable which you will collect monthly, right? So record it as receivable. Next one is material, labor, and overhead. Now, again, can you see all these are items which you can expend. These are not capital items. For what? For the prototype laser scanner. But economic viability is not achieved. So what do you think? You have to expend it. So just expend it immediately as R&D. Let's come to the next item. Cost of testing the prototype and design modification. Again, economic viability is not achieved. So if it is not achieved, no question, just expend it. Legal fees to obtain the patent on new laser scanner. So this is an allowable cost in the obtaining of this patent. Remember, when you buy a patent, you have to capitalize it. So yes, you can capitalize the patent and amortize the overhead as and when the time comes. Next comes executive salaries. Whatever it is salary. Salary is an expense. There is no question of any capitalization. So expend it as operating expenses. A cost of marketing research to promote new laser scan. Now again, this is just a research. Even though you're promoting a new laser scan, simply expend it as an operating expenses. Next example, here you have engineering cost incurred to advance laser scanner to full production stage, and economic viability has been achieved. Now here actually I can see two things here. One is the engineering cost. I have already underlined it. Engineering cost, and then secondly you have something like the laser scanner. So engineering cost may be expensed because it's just the cost of engineering, while anything that has been incurred further than that, where the economic viability has been achieved, you can treat it as a capital item. So expend it as a operating expense, that is engineering cost, while the value of your laser scanner can be capitalized. Okay, the next item, cost of successfully defending a patent on a laser scanner. So any cost of defending intangible asset can be treated as a capital item, isn't it? So you will capitalize the patent and amortize it as and when it comes. Last one is commission to sales for marketing staff. Uh, Here, sales staff marketing for new scanner. So it is just the commission that you paid for acquisition of new scanner, it's just the commission, so you will expend it as an operating expenses. Okay, I hope you will be able to understand each one of them. Please feel free if you have any questions to ask. Okay, so I'll move forward. Here we'll talk about other costs which are similar to R&D. Now, sometimes you have certain costs which can seem like it is R&D. I mean, which you will treat like an R&D expenses, though it is not an R&D expense. For example, any startup cost. Let's say you are starting a new operation, and you have spent a lot of money for starting those operations, maybe taking license or things like that. You cannot treat it as a capital expenditure, you have to expend it. Or initial operating losses, maybe you started a business and in the beginning stages you made some losses, you cannot collect it as a capital expenditure, you have to expend it. Or any advertising cost, whenever it is, wherever it is, any expenditure on advertising should be treated as an expense. So all these costs will be expensed as incurred like R&D cost. Okay, so that's all, and I will just look at this final example here. Let's say here is I think this one is exercise 12.17. Let's try to work on that. Okay, here decide whether it should be reported how it should be reported as R&D expenses. So we will identify only those expenses which are R&D. So here is a column where we will just take out the amount from the actual expenses which is shown here and decide how much of them will be expensed. Okay, let's start. Cost of equipment acquired that will have an alternative uses in the future also. So it is an equipment. Equipment is a fixed asset, so we need to capitalize this amount, that is 330,000. However, they are saying that the project is going to be used for next 5 years, and they use straight line method of depreciation. So yes, we have to calculate depreciation which will be expensed. How do we calculate that? 330,000 divided by 5. That would be 66,000, which will be considered as an R&D expense as and when it is expensed. Next, material consumed. Okay, it is fully expensed, 59,000. Consulting fees paid to outsider for R&D project. Consulting fees is an expensible item, so the whole of that will be expensed. Personnel cost, that is human resource cost involved in the R&D project. It is like paying salaries, wages and things like that. Whole of that can be expensed. Indirect cost reasonably allocatable to the R&D project. Anyway, it is indirect cost, the whole of that can be expensed. Material purchased for future R&D project. So it's not for current, it's for future. So maybe we can capitalize the whole of that. You don't have to expend it now, right? So the total amount that you can expend from this example is 403,000. I hope you got and you have understood this part of the chapter. With that, actually we finished this chapter. Here you can just have a look at this example where how you will be showing the R&D expense on an income statement. So on an income statement, you will see that R&D will be shown as a separate item. Okay, so that's all. I hope you have understood it, and I hope you will let me know if you have any questions. Okay, have a lovely time.